Have you ever had that moment, you're caught in the whirlwind of a busy day, stomach rumbling, and suddenly that craving hits for a perfectly customizable burrito, perhaps, packed with fresh, vibrant ingredients, or maybe a loaded bowl built just the way you like it.
Definitely.
For so many of us, that specific craving and the satisfying experience of fulfilling it quickly has become entirely synonymous with one name. Chipotle.
It really has.
It's more than just a place to grab a quick meal. For many, it's a habitual, even cultural touchstone.
It absolutely is. And what's particularly fascinating is that while millions of us interact with Chipotle primarily as, a go-to for lunch or dinner,
right,
from an investment perspective, it's a company that has ignited incredibly intense, almost passionate debate. On one side, you have those who champion it as a wonderful company, a truly elite business with competitive advantages strong enough to warrant a multi-decade investment.
Right.
But then on the other side, there's the equally fervent argument that its current valuation is simply pricing in a level of perfection that is, fundamentally unsustainable.
That's a massive question. And before we dive into the details, just a quick note for our listeners on all the resources that accompany this analysis.
Exactly. This 1-hour discussion is a deep dive, but the full, detailed research report with all the data is available as a PDF. It's the perfect companion document for those who really want to do their own due diligence.
And the link for that is right at the top of the description below.
And for those who want to act on these ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description as well, right?
That's right. All the resources are in the description. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel.
Perfect. Housekeeping is done. So let's get into it. Pillar number 1, the business model. How simple yet powerful it seems.
It truly is deceptively simple. The core economic engine is pretty straightforward.
Yeah.
Chipotle generates its revenue by selling food and beverages from its extensive network of over, 3,400 company-owned and operated restaurants.
Right. Company-owned. That's key.
It's a crucial differentiator.
Yeah.
Absolutely. Especially compared to many peers in the QSR space, quick service restaurant space, who rely heavily on franchising.
Mm-hmm.
By owning all its locations, Chipotle retains complete control over everything. Ingredient sourcing, customer experience, and critically, its brand messaging.
Total control.
It's direct sales of a highly focused menu, primarily burritos, bowls, tacos, and salads. No sprawling menus, no endless limited time offers.
Just the core stuff.
Just a few core, highly successful items.
And the genius of that focus becomes really clear when you step up to the line. That assembly line system, watching them build your meal right there.
Yep.
It's a brilliant operational solution, isn't it? It directly resolves that classic restaurant trade-off between speed and customization.
You get both.
Exactly.
Right.
Which is precisely what allows them to command a premium price in that fast casual niche. Positions them way above traditional fast food.
Absolutely. And the true genius isn't just the line itself, right? It's how their hyper-focused, incredibly simple menu amplifies its efficiency.
How so?
Well, by specializing in just a few core items with interchangeable ingredients, they significantly reduce complexity. In the kitchen, at the serving line.
Makes sense.
This allows for faster throughput, fewer errors, easier training for staff. Much easier than a more complex operation would allow.
Right.
This unique synergy directly impacts their ability to maintain both quality and speed at scale. It's a combination few competitors truly master.
That combination. Perceived quality, speed, personalization that carves out their spot.
Precisely. But the simplicity of the model, it goes even deeper. Think about the fundamental human desire for convenient, delicious, affordable food. It's timeless, an enduring constant. Chipotle tapped into a powerful structural shift in consumer behavior by layering their food with integrity philosophy on top.
Yes. Food with integrity.
Responsibly sourced, non-GMO, preservative-free ingredients. This isn't some fleeting dietary fad or marketing gimmick,
No, it feels more ingrained.
It's a durable shift in societal values toward health, transparency, ethical consumption. This commitment isn't just a selling point. It's a deeply embedded value system that resonates, creating this powerful, almost ideological bond with the brand.
And it's not just what they thoughtfully put into the food, it's also what they consciously don't allow onto the menu.
Right.
Their operational discipline historically has been immense. They've notoriously resisted the temptation to chase every new fad, right? Like adding breakfast or coffee or dessert.
Things that could dilute the brand.
Exactly. Or just add unnecessary operational complexity to that, that finely tuned assembly line.
Like bog it down.
That unwavering focus, I think, is a critical yet often overlooked element of their profound long-term success. It's testament to management's clarity.
I couldn't agree more. And that discipline has extended beautifully into their digital transformation, which has actually fortified their core model rather than complicating it.
How so? Because digital can often add complexity.
True, but think about their sophisticated mobile app, their loyalty program, which now boasts an astonishing, over 40 million members?
40 million, wow.
And their innovative rollout of Chipotlanes, those dedicated drive-through lanes specifically for digital order pickup.
Right, the pickup lanes.
In 2022 alone, digital sales accounted for a remarkable 39.4% of all their food and beverage revenue.
Nearly 40%. That's huge.
And this digital ecosystem isn't just an add-on, right? It's not just convenience. It's a strategic bypass. Chipotlanes, for instance, allow them to significantly debottleneck their busiest locations.
Ah, interesting, like adding capacity without chaos?
Exactly. Boosting throughput without the slowdown of a traditional drive-thru. It's a physical manifestation of their digital strategy, optimizing real estate and throughput in a way few others in the industry have managed.
So they're not just selling burritos.
No, they're selling a value system delivered through a hyper-efficient, highly convenient, and increasingly personalized operating platform.
Creating that emotional and habitual bond.
Which becomes exceedingly difficult for any competitor to replicate.
Okay, so if that's the meticulously crafted business model, how does Chipotle truly defend that position? What stops others from just copying them? Let's talk economic moat. How do they build and maintain that fortress?
That's the crucial question, yeah. And the answer lies in a combination of reinforcing advantages. The primary moat is clearly its intangible assets, specifically the extraordinary power of its brand.
The brand.
This brand hasn't just been built. It's been painstakingly cultivated over 3 decades. It's now synonymous with a unique, aspirational value proposition. High-quality, fresh, ethically sourced food served quickly at a premium.
Food with integrity again.
It's the central pillar, their identity, mission statement, what fundamentally enables those premium prices. It creates a powerful psychological barrier for consumers.
Positioning them above fast food, but more convenient than casual dining.
Precisely. And what's truly remarkable here is the brand's demonstrated resilience. Even after facing those severe food safety incidents between, 2015 and 2017?
Right, that was rough.
The brand not only recovered, but thrived. This extraordinary recovery, testament to deep customer loyalty, is exactly why leading investment analysts consistently assign Chipotle a wide economic moat rating.
A wide moat.
Oh.
Okay. And then alongside that powerful brand, you also highlight supporting moats like cost advantages. How does a restaurant chain get genuine cost advantages? Seems tough in that industry.
That's an astute point.
Right.
But with over 3,400 company-owned locations and a clear path to 7,000, scale is everything.
Okay, scale matters.
This large, growing network lets them cultivate and manage a sophisticated, specialized supply chain for their unique ingredients. Think specific avocados, cuts of meat, even subtle spice variations.
The stuff that makes it taste like Chipotle.
Exactly. That kind of supply chain would be exceedingly difficult for any new entrant or smaller competitor to replicate at a comparable cost or quality. Scale gives them significant purchasing power, better terms, better prices from suppliers.
Which smaller players just can't get.
Right. Additionally, that high-throughput assembly line isn't just about speed. It's a model of operational efficiency, maximizing revenue per hour, minimizing waste through precise portioning, streamlined workflows. They achieve superior unit economics.
Better profits per store.
And the Chipotlanes, as we touched on, management explicitly identifies them as their highest margin channel, significantly improving the economics of each new location.
You can really see this powerful moat in action when you look at their pricing power. I mean, we've all seen the price of a burrito creep up over the years, seemingly without much pushback.
You're absolutely right. The most tangible, maybe the most undeniable evidence of Chipotle's moat is its sustained, proven pricing power.
They just keep raising prices.
Consistently, passing on rising food, labor, operational costs through menu price increases, often multiple times a year, with little to no material impact on transaction volumes.
Which tells you people see the value.
It tells you customers perceive a unique value proposition that unequivocally justifies the higher price. Charging upwards of $10, even $12 or more, for a burrito or bowl, while competitors anchor to dollar menus. That's profound brand power.
Clear exercise of that power.
And the digital ecosystem is a second equally powerful example, the Chipotle Rewards program. It gathers massive amounts of valuable customer data, obviously.
Marketing, menu ideas.
But it also creates a subtle yet powerful switching cost. If you have your payment info, favorite orders, loyalty points saved in the app,
you're less likely to jump ship. Exactly. Less likely to go elsewhere for a marginal difference. That digital platform, now over a third of sales, adds a formidable, increasingly sophisticated layer of defense.
So this moat isn't just stable, which would be good enough for many businesses. You're suggesting it's actually widening over time.
The evidence strongly suggests precisely that. The digital ecosystem, that 40 million member loyalty program, powerful defenses built almost entirely in the last 5 years, largely under current leadership.
Relatively new developments, then.
Yeah. And each new Chipotlane adds a high-return, high-convenience asset that deepens the connection with their most loyal, most valuable customers.
And you see this in the data.
We see it quantitatively. Between Q2 2019 and Q2 2024, the proportion of customers visiting at least twice a month increased significantly, from about 23% to nearly 30%.
Okay, that's a real jump in frequency.
That's a clear, quantifiable indicator of deepening loyalty and an actively widening moat. While sure, barriers to entry for a single burrito shop are low.
Anyone can open one. Replicating Chipotle's integrated system. The brand equity, the scaled supply chain, operational efficiency, the digital infrastructure. It's an immense, almost impossible undertaking for competitors. It's not just a chain. It's an ecosystem.
That paints an incredibly strong, almost unassailable picture. But, this is the deep dive. We don't stop at the surface. You also performed what you call a Scuttlebutt simulation, digging into the unvarnished, real-world feedback from customers and employees.
Right.
And what you uncovered there, I think, offers a surprisingly different, maybe even concerning perspective on Chipotle's day-to-day operations, didn't it? Found some cracks in the fortress.
Yes. This is precisely where the fascinating tension within the Chipotle story becomes, glaringly evident. There's absolutely no doubt that a huge number of customers deeply love the core product.
The food itself is good.
Flavor, freshness, perceived quality are consistently praised, reflected in a positive net promoter score of plus 17, healthy base of loyal promoters. However, when you dig beneath the surface into platforms like Reddit, consumer affairs, social media forums, a very persistent and troubling pattern of complaints emerges. Not just isolated incidents, suggests something systemic.
Okay, what are those key recurring themes you found?
The two overwhelming, consistently vocalized themes are, first, deeply inconsistent portion sizes.
Sipping charge.
It's rampant. Countless social media posts, reviews with side-by-side photos, a generous bowl from a few years ago next to a current one noticeably less filled. Especially the protein.
People notice that.
It's not just about food quantity. It's about a perceived breach of the value contract. Customers feel they're paying a premium price for a diminishing experience. Directly chips away at the brand's integrity promise in their minds. Highly emotional point for regulars.
And the second theme?
The second, equally pervasive theme is poor service and order inaccuracy.
Okay.
Widespread complaints. Rude or disengaged staff, dining areas noticeably unclean, and, critically for their digital strategy, a high frequency of incorrect or missing items in digital orders.
That kills the convenience factor.
Absolutely. And this isn't just a few bad apples or isolated incidents. The sheer volume and consistency strongly suggests these are systemic operational challenges. The brand promises premium, reliable, high quality.
But the execution doesn't always match.
Right. The execution at store level appears to be a significant, maybe growing, source of customer friction, directly contradicting that premium promise.
So why is this happening? You looked beyond the customer complaints to the employee perspective. That seems to be the crucial canary in the coal mine here, pointing to the underlying cause.
That's exactly right. While high-level corporate surveys might report, say, 67% of employees consider Chipotle a great place to work, sounds positive, right?
On the surface, yeah.
Anecdotal reports from frontline workers on public forums, they tell a very different, much more concerning story.
What are they saying?
Employees frequently describe being horrendously understaffed, feeling immense, almost impossible pressure, doing the work of multiple people during peak hours, overwhelming workloads, constant stress dealing with demanding customers, high-pressure environment, leads directly to widespread burnout.
And high turnover, presumably.
Exactly. High turnover.
And one employee even described it as a vicious cycle, didn't they? That's particularly insightful.
Yes, a truly profound and concerning description. They explained that severe understaffing makes it virtually impossible to properly train new hires.
No time to train.
Right. They're immediately thrown into the deep end, become overwhelmed by the chaos, lack of support, and subsequently quit.
Which just makes the staffing worse.
Which only worsens the staffing shortage, perpetuating the cycle.
Oh.
This narrative suggests a potential breakdown in the company's ability to maintain its celebrated people-centric culture and operational standards at the foundational restaurant level.
So connecting the dots.
When you connect the dots, these widespread negative customer experiences, the portion skimping, the poor service, the order errors, are direct, observable symptoms of the profound underlying stress and operational strain within the workforce.
The brand promise relies on happy, effective employees.
Exactly. Chipotle's primary moat, its brand, is built on the promise of superior product and a consistent positive experience. That promise isn't delivered by executive strategy. It's delivered moment by frontline employees.
And if they're struggling,
if those employees are chronically overworked, undertrained, fundamentally demoralized, they simply cannot consistently deliver the high-quality execution required to justify a premium price point.
So the market might be missing this, focusing on the big picture.
The market might be primarily focused on the successful high-level strategy, the digital growth, the store expansion plans, while overlooking a fundamental slow-burning operational decay that quietly threatens to erode the entire fortress from within.
That's a critical insight, truly connecting the internal employee experience to the external customer perception. Could have long-term implications, paints a more complex picture of their defenses, but a great business, even with issues, needs great management. So, let's shift focus. Is this ship in good hands?
In terms of high-level leadership and capital stewardship, the answer appears overwhelmingly positive. Brian Niccol became CEO in March 2018, arrived at a truly pivotal moment, right? Company still reeling from the food safety crisis.
Yeah, tough time to take over.
He was brought in specifically to bring fresh energy and leadership to drive excellence. And by all credible accounts, his tenure has been a resounding success. Dramatic operational, financial, cultural turnaround brought the brand back from the brink.
And he's clearly articulated a very focused operating philosophy, hasn't he? Seems foundational.
He absolutely has. His operating philosophy is consistently articulated, remarkably clear, unequivocally focused on long-term value creation, not just short-term gains.
Moving from turnaround to growth.
Skillfully guided the company from a precarious turnaround phase to a robust, sustainable growth trajectory, built on what he calls 5 strategic pillars.
Okay, what are they?
1, running successful restaurants with a people-accountable culture. 2, sustaining world-class people leadership. 3, making the brand visible, relevant, and deeply loved. 4, amplifying technology and innovation. And 5, aggressively expanding access and convenience through new restaurant openings.
Seems comprehensive, holistic.
It demonstrates a holistic, owner-oriented mindset, focused on relentlessly strengthening the foundational elements rather than, fleeting financial engineering.
So how has that philosophy translated into actual capital allocation? Where's the money going?
Their deployment of cash flow has been exceptionally rational, disciplined, hallmark of sound management. First and highest priority by a significant margin. Continuous reinvestment back into the core business, primarily new restaurant openings.
Makes sense, given the returns.
Most logical, value-accretive use of capital. Superb unit economics, consistently high returns on new stores. The strategic focus on Chipotlanes further enhances these already attractive returns, higher throughput, higher margins.
And they're building a lot of them.
For 2024, guided for a substantial 315 to 345 new openings. Over 80% specifically, including that high-margin, high-convenience Chipotlane format. Clear strategy. Grow through high-return internal investments.
Okay, but what about acquisitions? Do they try to buy other chains? Empire building?
That's a critical point, and where their discipline really shines. Admirable restraint. Actively avoiding those empire-building tendencies.
They did try a few things, though, right? ShopHouse.
They did. Past forays into other concepts like ShopHouse, Southeast Asian Kitchen, Pizzeria Locale. But these were ultimately unwound. when they didn't meet Chipotle's rigorous internal expectations for growth, profitability, or brand fit.
Willingness to admit mistakes.
Shows a leadership culture not afraid to admit mistakes, cut losses quickly, decisively refocus on core strengths, powerful hallmark of rational allocation, long-term thinking.
And shareholder returns. No dividend, but buybacks.
Right. No regular dividend, but a long, consistent history of aggressive stock buybacks. Example, 2024 alone, repurchased nearly $1 billion, $995.8 million of their own stock.
Shows management thinks the stock is a good buy.
Indicates that belief, yeah. And the board recently approved a significant 50-for-1 stock split. Another shareholder-friendly move aims to make ownership more accessible, broader base of investors, commitment to liquidity, retail participation.
So if we put this leadership through a rationality test, evaluating their decisions against long-term value creation principles, what's the conclusion?
The evidence overwhelmingly points to a management team that consistently thinks and acts like long-term owners. Their capital allocation hierarchy is explicit, clear, perfectly logical.
What is it?
First, prioritize funding all high-return internal growth, especially new stores. Second, consistently maintain a rock-solid, fortress-like balance sheet for resilience. And only third, after those priorities are met, return all excess cash to shareholders, primarily via opportunistic share repurchases.
Textbook sound stewardship.
Truly. Maximizing long-term value compounding.
Nice, powerful, qualitative assessment. But let's look at the hard numbers. How strong is the financial fortress? Are the financials as robust as the story suggests?
The financials are indeed remarkably robust, with the, notable exception of that temporary but severe trough from the 2016 E. coli crisis.
Right, the blip.
Chipotle has proven itself a remarkably consistent, incredibly powerful earnings machine. The dramatic turnaround under Niccol is unequivocally clear in the numbers.
Give us the highlights.
Revenues surged from $4.5 billion in 2017 to over $11.3 billion for the trailing 12 months. And critically, net income exploded from a mere $176 million to an impressive $1.53 billion over a similar period.
Wow, huge jump in profitability.
It's not just growth. It's a powerful demonstration of scalability, operating leverage, profitability of their tightly managed model.
And you highlighted some specific key quality ratios that really speak volumes. Let's walk through those.
Absolutely. Let's start with return on invested capital, ROIC, arguably the ultimate measure of true business quality, how efficiently a company uses capital to generate profits.
And Chipotle's ROIC.
Consistently high, and more importantly, on a clear upward trajectory, rising from a post-crisis low to a current trailing 12-month figure of approximately 20%.
20% ROIC. How does that compare?
To put that in perspective, their estimated weighted average cost of capital, the minimum return needed to satisfy investors, is maybe 9 to 10%. In the broader restaurant industry, average ROIC hovers around a mere 4.2%.
So way, way higher.
What this 20% ROIC truly signifies is that for every dollar Chipotle reinvests building new stores, upgrades, tech series, they generate twice the return needed to cover their cost of capital, and an astonishing 5 times what the average restaurant achieves.
Powerful engine for compounding wealth. Clear evidence of a durable moat.
Exceptional value creation, absolutely.
So excellent returns on investment. What about cash flow? Is it a cash-generating machine?
It absolutely is. Consistently converts a remarkably high percentage of net income into actual free cash flow, the cash truly available after all expenses.
And the operating model efficiency, you mentioned something called a negative cash conversion cycle.
Yes, exceptionally efficient. Averages approximately -4 to -6 days. What that means in plain English is profoundly powerful.
Okay.
Chipotle collects cash from its customers before it has to pay its suppliers for ingredients and other operational expenses.
So they get the cash first.
Provides a substantial, permanent working capital advantage. Essentially, a continuous interest-free float or internal financing source, like customers are prepaying, funding part of their operations.
That's a huge advantage. And finally, balance sheet strength. How robust is it?
The balance sheet is, without exaggeration, a veritable fortress. Their net debt to EBITDA ratio, key leverage indicator, steadily declined over the past 5 years to a very conservative level, around 1.1 times.
Very low leverage.
Exceptionally low. Provides an enormous margin of safety, ensures they can comfortably navigate downturns, absorb shocks, address challenges like another food safety scare without financial distress or needing to raise dilutive capital. Picture of profound financial health.
Okay, so we've just established unequivocally Chipotle is a truly wonderful company. run by excellent management, strong moat, rock-solid financials. But the cardinal rule, even a wonderful company can be a poor investment if the price is too high. So let's pivot. The crucial price-to-value question. Is this wonderful company a wonderful investment at its current price?
This is indeed the crucial judgment call, where all the analysis converges. The market clearly is fully aware of Chipotle's exceptional quality, reflected in demanding valuation multiples.
What are they looking like now?
Stock currently trades at a staggering price-to-earnings ratio of approximately 50 times trailing 12 months earnings, and a price-to-free cash flow ratio around 52 times.
50 times earnings, wow. Is that high historically for them?
Well, notably, the current PE is below its often volatile 5-year average of roughly 66 times. So maybe a slight cooling in euphoria.
Maybe.
But it remains at a level that is objectively high by almost any historical standard for any business, let alone a restaurant chain.
So what does a valuation this demanding, say 50 times earnings, implicitly demand? What future performance is baked in?
It's the critical point often overlooked. While Chipotle is undoubtedly wonderful, a valuation of 50 times earnings, 52 times free cash flow. It isn't just pricing in continued success, it's effectively pricing in a decade of near-flawless execution and robust growth.
A decade of perfection.
Which leaves a perilously thin, almost non-existent margin of safety for an investor. Simply doesn't adequately discount the possibility of a future food safety incident, a growth slowdown, or those systemic operational stumbles we identified in the Scuttlebutt.
No room for error.
An investment at this level isn't just betting on success. It's a wager the company can materially exceed already lofty expectations. That, for a long-term, value-oriented investor, is a difficult, inherently low-probability bet. Requires everything to go perfectly or even better.
Given that high bar, what are the primary identifiable drivers for future growth? And maybe more importantly, what are those permanent impairment risks that could truly damage the business long term?
The single most important identifiable driver for future earnings growth. Continued, aggressive expansion of its restaurant footprint.
More stores.
Management's clear, ambitious long-term goal. Reach 7,000 restaurants in North America. Substantial increase from the roughly 3,400 today. Effectively provides a visible multi-year runway to more than double the physical size.
That alone drives significant growth.
Should drive significant top-line revenue, bottom-line earnings growth, for at least the next decade, maybe longer. Furthermore, international expansion still nascent, but
like the Mexico deal,
exemplified by the New Mexico agreement, other early explorations, represents a significant, likely underpriced, long-term growth option. Could surprise investors to the upside in future decades.
But even strong businesses face risks. What are the permanent impairment risks for Chipotle? The kind that fundamentally change the case, not just cause a temporary dip.
The first, arguably single most potent permanent risk, a catastrophic food safety event.
Still the big one.
Chipotle's model, fresh, unprocessed ingredients, meticulous in-store prep, rapid assembly, central to the brand promise. But that same reliance inherently makes it more vulnerable to widespread foodborne illness outbreaks than competitors using more centralized processing or prepackaged stuff.
The freshness is also the risk.
A severe, widespread incident gains national attention, lingers. Could permanently shatter the food with integrity promise. That core promise, once broken, could irrevocably destroy the trust underpinning its premium pricing, customer loyalty, potential long-term decline. The second is a slower, far more insidious threat. Systemic erosion of brand value.
Back to the Scuttlebutt.
As identified there, troubling signs of systemic stress at store level already exist. If inconsistent portioning, persistently poor service, declining operational execution driven by underlying employee morale, understaffing become the new, ingrained norm.
The premium perception erodes.
Inevitably, irreversibly. The skimping charge isn't just anecdotal. We see the photo comparisons. It's a perceived breach of the value contract. Customers wouldn't see the unique value justifying the premium price. Margins compress as pricing power fades. Moat breached not by a competitor, but by internal failure.
Failure to deliver the promise.
Exactly. Failure of execution and adherence to their own brand promise.
And finally, broader industry challenges, labor costs.
Absolutely. Entire restaurant industry facing significant structural headwinds from rising labor costs, intense competition for staff, government mandates like California's AB 1228.
The fast food minimum wage there?
Right. While Chipotle has shown pricing power, there's always a limit. How much cost can be passed on before impacting traffic, perceived value? A permanent structural increase in labor costs, outpacing price hikes or efficiency gains, could significantly compress their industry-leading restaurant margins, impair long-term profitability.
This brings us to second-level thinking. How does our analysis here potentially differ from, or even challenge, the prevailing market consensus on Chipotle?
Crucial distinction: the prevailing market narrative. Overwhelmingly positive, almost universally. Consensus rating among analysts generally buy or moderate buy. Market sees best-in-class operator, unassailable brand, long growth, runway, stores, Chipotlanes, world-class management.
And the high valuation.
Often simply accepted as the price of admission for such a premium, high-quality asset. Market's primary focus: squarely on the successes: digital growth, margin expansion, path to 7,000 stores.
But our analysis, maybe a contrarian view, places weight elsewhere, on something the consensus might be underestimating.
It does. Our analysis crucially differs by placing significantly more weight on escalating risks from the frontline employee and customer experience. The market, in our view, seems to be extrapolating executive strategic successes while potentially underestimating the inherent fragility of execution at the critical point of sale the restaurant floor.
Consensus sees the brand as durable, overcoming hiccups.
We, however, view the brand as extraordinarily valuable, but also delicate, an asset being actively, albeit slowly, degraded by systemic operational challenges documented in our Scuttlebutt.
And the key factor the market might be ignoring:
the direct causal chain. Sustained employee stress, pervasive understaffing, inconsistent execution, negative, frustrating customer experience, erosion of brand's hard-won pricing power.
A slow burn.
It's a slow-burning foundational risk. Won't necessarily show up red-flagged in a quarterly report until damage is significant, maybe irreparable. Could undermine the entire investment thesis over time.
Okay, let's bring all these threads together. For you, the listener, trying to synthesize this complex picture, what's the one-pager view? Let's start with the bull case, the core reasons to own Chipotle.
The bull case is undeniably robust, multifaceted, first, dominant brand, remarkably durable model. Food with integrity ethos cultivated a powerful, widening moat, premium pricing, exceptional loyalty, simple, understandable, enduring model.
And then the numbers.
Exactly. Second, exceptional financial quality. Consistently generates elite rising ROIC around 20%. Far exceeds cost of capital, industry averages, converts profits to free cash flow efficiently, variable fortress balance sheet, minimal leverage, immense safety.
Plus that long growth runway.
Third, clear, profoundly defensible growth runway. Management's visible path to more than double North American restaurants to 7,000 stores.
Yeah.
Multi-decade engine for unit growth, powerful value compounding.
And finally, management.
Proven, rational management. World-class CEO, clear long-term vision, demonstrated track record of remarkably disciplined, value-accretive capital allocation, prioritizing high-return internal growth.
So that's the powerful bull case. Very compelling. But then the bear case, the counter thesis, reasons not to own it or at least be very cautious.
Primary concern: commanding valuation, over 50 times trailing earnings. Fully prices in years of future perfection, virtually no margin of safety.
Okay, valuation first, then.
Second, mounting evidence of insidious erosion of customer experience. Systemic issues, understaffing, poor morale, inconsistent service, portioning, threatens brand premium from inside out.
The internal threat.
Third, acute permanent food safety risk. Business models' reliance on fresh in-store prep creates unique, persistent vulnerability. Catastrophic event could impair brand earning power overnight.
The nightmare scenario.
And finally, persistent structural margin headwinds. Rising labor costs from regulation, competition. While Chipotle has pricing power, there's a limit. Could structurally challenge industry-leading margins long-term.
This is where we bring in our red team challenge. Inverting the bull case. Why, despite strengths, investing today could be a major mistake.
The bull case fundamentally rests almost entirely on brand durability and pricing power, which drives high returns, justifies growth story, and premium valuation. An investment today becomes a monumental, potentially devastating error if we are paying a premium price for a business whose qualitative foundation, the very bedrock of its competitive advantage, is already past its peak.
So in this scenario, the scuttlebutt isn't just noise, it becomes a critical leading indicator.
Precisely. In this failure scenario, pervasive scuttlebutt from disappointed customers, stressed employees, isn't anecdotal noise. It transforms into the definitive leading indicator of terminal decline in operational execution.
The vicious cycle takes hold.
That vicious cycle, understaffing, burnout, high turnover, becomes entrenched. maybe unsolvable. In-store customer experience continues its slow, undeniable degradation. Skimping narrative solidifies into widespread perception. Brand identity shifts from integrity, premium value to inconsistency, diminishing returns. Loses its halo.
And what happens to a business like Chipotle when its brand, its primary moat, loses that halo?
Pricing power, most tangible evidence of the moat, gradually vanishes. Can't confidently pass costs. Customers don't see superior value anymore. Less differentiation between a $12 Chipotle bowl and a $9 or $10 competitor. Same-store sales stall, turn negative.
Margins get crushed.
Restaurant margins, caught between stagnant pricing, rising costs, are inexorably crushed. High ROIC declines toward meager industry average. The 7,000 store growth story, once a beacon, becomes a liability. Unit economics no longer justify expansion.
And the stock.
Stock's premium multiple, once a badge of honor, collapses under the weight of a broken growth narrative, rapidly deteriorating fundamentals.
So the critical error wouldn't be misjudging past success, but rather
fundamentally failing to recognize that the very foundation of its future quality and profitability was quietly crumbling in plain sight, despite past successes, high-level strategic pronouncements. The disconnect between boardroom and serving line proves fatal.
And that, I think, perfectly encapsulates the fascinating duality of Chipotle, doesn't it? On one hand, fundamentally strong business, excellent financials, world-class management, but on the other, burdened by extremely high valuation demanding perfection and persistent internal operational cracks that could erode core brand strength.
It's a compelling case study. Forces you to reconcile two very different realities: executive brilliance, financial robustness, versus what's actually happening at the front lines day in, day out. The tension between those two narratives makes it such a rich, challenging subject.
So, for you, our listener, here's a challenging thought as you consider this. Given the seemingly contrasting picture-strong corporate strategy, potentially struggling frontline execution, what specific, actionable early indicators would you personally look for to determine if Chipotle's brand equity is truly beginning to erode materially, or if these are just growing pains on the path to 7,000 stores? How would you reconcile these two powerful but conflicting narratives in your own investment or consumer decisions?